Thank you so much, Aditya, for having us, and it's a pleasure to be speaking to all of you here. And a very good evening. So, without further ado, let me dive right in, and I'll basically start off by setting the context for how we think about structured products, and why they essentially are something that Indian investors do need right, in their portfolios. So, and from there I'll just give a brief background of our desk, right, which is now more than a decade old. So very quickly, I think structured products as a product is something which is as mentioned in the last session as well, it is still in its infancy stage, if I can say. Primarily, if you look at the allocations of investors anywhere across the world, right, structured products tend to form an allocation of anywhere between 10 and 30% of investor portfolios. Whereas when we would look at similar statistics for India, I think that number will be like barely 1 or 2%, right? That too only in the HNI audience. And so there is a significant value that these products provide. Where that value really comes in is that, SEBI coined a name for these products, structured products. SEBI called it market-linked debentures. I think that's the cornerstone of the value that they provide. They are essentially debentures, right? When you say debenture, it means they have a fixed return orientation in them, which means they have the ability to protect your capital, right? So it is more like a fixed income instrument that you purchase. However, the coupon, right, traditionally on a fixed income instrument is fixed, right? The variations are what frequency you will receive that coupon at, right? But what changes with structured products or market linked debentures is this coupon is then linked to some underlying market. And again, globally, these markets are across all possible asset classes. So you will have structures around obviously equities, you will have structured products around rates, you will have structured products on commodities, currencies. So the whole, like any asset class that you can imagine, there will be products available on those. Whereas when you bring that to the Indian context, India is still, I would say 95% is oriented towards fixed income, and maybe a 5% share towards equities. Within the 95% fixed income oriented structures, the underlying can vary between a GSEC and some sort of an equity underlying for a certain kind of kicker. But I think that's sort of the length and breadth of the underlyings that we see. And sort of that's what actually brought us to think about the product that we'll be sharing with you in a bit. So as I said, I think that's the cornerstone of this. They do enable very unique diversification in your portfolios, because all the investments that you make either carry absolute fixed income nature or absolute equity. But for an investor who is looking to participate in equities, but let's say the risk never, sort of fits their appetite, right? And for that reason, they tend to stay away. Again, looking at a structured product with an equity underlying, you can maybe participate in equity markets like Nifty, but with capital protection on the downside. Now that is a feature that is absolutely unique to these products, and potentially can open doors for a large number of investors, right, who still are sitting on the fence from the equity markets. Obviously, these are tailor-made solutions, so they can be customized depending on the market view, depending on specific requirements for large investors as well. Also, they are technically more efficient investments versus traditional fixed income, both in terms of the coupon being linked to an underlying market. So for example, even if you do a rate linked structure, right, you can benchmark it to, let's say, GSEC. So if the rates go up or down, proportionately your the coupons that you are earning from these products can help you tide over varying levels of inflation in the market, right? And lastly, I think the issuance structure for these products, etc., has also evolved there is most of these instruments issued in India are now in a secured format, right? And there is a high level of due diligence that is done on the asset cover, all the covenants by an independent trustee for each of these issuances. So all in all, the unique investment strategy coupled with the regulatory framework, the entire due diligence framework for issuing of these products, I think the stage is set for structured products in India to take off. I think we would love to be part of this journey. So just very quickly giving you a rundown of the desk at Edelweiss Structured Products. So we have, I would say we would be one of the, longer sort of journeys in this space. The desk was started in 2007. We would be, the first Indian entrant in the market linked debenture segment. There were a lot of MNC banks, which had entered the markets before. Obviously, given their global experience, they're the ones who brought this product to India. And I think given Edelweiss's capabilities on the derivative segments and our understanding of the same, we also chose to operate in this right from 2007. We have over these 15 odd years issued more than 21,000 crores, so close to $3 billion, right, worth of issuances over these years. And out of that, we have redeemed successfully 15,000 plus crores. So our current book would be just over 6,000 crores. I'm happy to say that all 15,000 crores that we have redeemed performed as promised. Whatever payoff we had promised, we were able to generate the same. We were able to make all our payments on time. So I think it has all in all been a successful journey, and with the products achieving their intended investment objectives. So again, in terms of track record, it's a quite successful track record. Also, we have over these years, the idea has not just been to be there, but to also expand the market. So we have actually built a robust network through the private banks, wealth outfits, multifamily offices, who typically cater to advise HNI and ultra HNI investors. That's primarily been the target audience. Also, of late, we are seeing increased interest from corporates and as well as institutions in these products. As I said, these are highly customizable. And yes, definitely. So, one of the points that was made was market linked debentures in India today are being used as a fixed income alternative largely. But, we continue to remain one of the oldest and the leading sort of players with capabilities around equity oriented products. So, which is why, the product that we are going to be discussing with you now is something that comes as a genesis of or is part of our attempts to really kickstart, catalyze this journey of true blue market linked debentures to grow and develop in India, right? And so without further delay, I'll hand over to Ajay Vora. So Ajay, if you will if you can take us through the product offering that we have created. And
sure. Thanks a lot, Pratik. So I think as Pratik also mentioned, and I think the earlier speaker was talking about it, that in India, if you look at it, most of the products which are being offered has, the underlying will always has most of the times been nifty. But over here, we just thought of this whole idea where if a particular portfolio is able to deliver far superior returns than the benchmark indices, the investors should get the double benefit. One is the overall, the benefits from the structured products itself, the features which it offers. And secondly, the outperformance of the portfolio versus the indices. And so what I'll do is, to start with, I'll talk about why we feel our portfolio can do relatively better versus the index. And then maybe again, Pratik can talk about how we have structured the product basis our index, basis our portfolio. So LEAP is a index which is nothing but our portfolio, right? And this is constructed on a certain thought process basis, our understanding of the market. So I'll just briefly talk about our thought process and then the strategy. So if you look at, the Indian markets is definitely a growth market. And when the growth accelerates, you'll see, a market's doing pretty well. But at times, we are also stuck in a very, a very narrow band of earnings, where because of many factors, the overall Nifty earnings growth has remained subdued. And that is what, if you look at, from FY17 till FY20, you will see that, the Nifty earnings was broadly in the range of around 400 rupees to 450 rupees. So over a period of 3 years, the EPS moved just from 400 to 450, and therefore the returns were also not that great. But post COVID, if you look at it, FT earnings moved from 450 rupees in FY20 to almost 530 in FY21, and straight away to 730 in FY22. So the journey has been fantastic over last 2 years, where we moved directly from 450 rupees EPS to 730, and that is the key reason why we see why we saw a very sharp move in the Nifty as well. And along with that, came the overall multiple expansion, the valuation expansion, which helped Nifty almost double over a period of 2 years. But now, if you look at it, going forward, things are normalizing globally as well as in India. And we'll be again back to, that 10-12% earnings growth, because, some sectors would be doing fine and some sectors would be doing great, whereas some sectors would not be doing that fine. So the point is that, all those things will come together, resulting in Nifty earnings likely to be pretty much in a range of around 10 to 15%, rather than a very high growth period which we saw earlier. And so if you can just move to slide 14, Pratik. And therefore, if you see, what is, so generally in each of the phase, historically, we have seen that although, the Nifty earnings has been subdued, say in single digit or low double digit, but there would be n number of sectors which, performs pretty, almost 2x, 3x that of Nifty. So if you look at in 11 to 14 phase, you'll see that, sector like IT and consumer staples, they were growing at almost 3x that of Nifty. And of sectors like financials and materials, they were underperforming the Nifty, right? But in March 14 to March 17 phase, if you look at it, financials and materials were growing at almost 22 to 25, versus Nifty growth was only 13%. So the point what I'm trying to drive is that, you'll always see a mix of outperformance and underperformance from the large sectors in different phases. And therefore the Nifty earnings may remain, subdued. But if you are able to construct a portfolio which is more growth focused and identify the sectors which can grow 2x, 3x that of Nifty, it will be, endeavor to deliver a decent alpha over and above the benchmark performance. So a very classic example, recently we saw that, post March 20 till almost 22, or I would say late 21, December 21, we saw IT and metals being the best performing sectors in the country. And suddenly, over last 5 to 6 months, both the sectors have been underperforming in a big way. So I'm just trying to give an example that while constructing the portfolio, we need to be sure what theme which we are playing in. And maybe if you go right to a very large extent, the outperformance on the portfolio can be pretty significant. And so this is, how we construct the portfolio. So right now, these are few themes where we are extremely positive about, and basis that we align the portfolio, so that, although some of these themes may not be part of the benchmark indices, but if you are able to capture them early, our portfolio, which is the LEAP portfolio, which is an index, can outperform the index in a pretty significant way. So, capex recovery is very much visible because of the government actions, government capex, private capex announced by n number of industries, the PLI schemes announced. So when this whole theme picks up, you'll see the entire banking sector also start doing well, and lot many other ancillary industries also start doing well. So, the clear example is that if you look at the credit growth, which was around 5-6% few quarters back, has moved to almost 15%, both on back of retail demand as well as corporate demand. So these are few sectors, which falls under the part of capex recovery where we are positive. Then you have the entire housing sector. So we feel that, the whole real estate sector in India is coming out of consolidation after almost like 10 years. The number of players have gone down by 70%. And there is a completely different affordability which has come up in the country, resulting in, a multi-year, multi-quarter high sales numbers. So just to give you a sense, last year, India as a whole sold close to 650 million square feet. Whereas in the first quarter itself, India has sold almost 200 million square feet. So you can see that, the growth rates are pretty much visible. And as we all know, housing is a very large part of the Indian economy. So once that triggers, you need not play only through the developers, but there are n number of industry which ends up benefiting through this. And similarly, we can talk about the electric vehicle, which is very much known to everyone. But to a very large extent, it is not part of the, you can't play that theme through the index. And similarly, defense is not very much part of the overall index. So these are few themes which we keep in mind and where we turn positive and ensure that our portfolio is aligned to these themes, so that the LEAP index ends up outperforming the overall benchmark index, which is the Nifty. And then it's the structuring which we do eventually, which will help the investors benefit from this particular. So before we get into the structuring, I'll just spend a couple of minutes on how we construct the portfolio. So we have a universe of close to 120, 130 companies. And honestly, these are pretty hygiene factors basis which we select the universe. So basis, the economic modes and the competitive advantage of the company, the track record and the governance history of the management. And eventually, the valuation is what matters a lot. So basis all these things, we select a universe. And then as we discussed, just a few minutes back about the theme where we are positive, we select a portfolio, we select the stocks and construct a portfolio of around 25 to 30 names, which can have a mix of around 70% large cap and 30% mid cap, where we restrict our overall weightage is also a maximum weight of 8% and minimum of 2%. So this is how we construct the portfolio basis the quality stocks and the valuation and all, where we see on at least 2 to 3 year basis, the compounding can be far higher than the Nifty compounding. And what we have done is we have assigned this whole thing to Care, who manages our portfolio's index, and one can see the NAV of our portfolio on their website on a daily basis. So they can completely get a sense in terms of how we are performing versus the benchmark. And maybe now Pratik can talk about how we have structured this basis the LEAP index.
Absolutely. Thank you so much, Ajay. So the opportunity here, right, and the genesis of this thought for us as one of the players in structured products, we've been structuring products for I think over 10 years on Nifty, and Nifty would be a very, very large part of the equity book, right? But whenever we are actually discussing, right, or we are exploring the equity or, what are the options available to investors to invest in, and what are the criteria that people evaluate, right, when they choose where to make their equity investments, the first parameter that comes up is whichever fund house I'm investing with, what is their track record. The idea behind looking at that is you want to go with someone who is consistent, who has consistently delivered alpha over the benchmark, right? So it's a large cap fund. You want the manager who has consistently delivered alpha, ranks amongst the top in that category. So we said that, we've been trying to solve a problem where we've been structuring products on the index, something that anyone can buy right through an ETF format. It's basically out there for anyone to purchase, but it is a much smaller set of investors who are looking at the index. But the rest of the money is only chasing is only focused on your ability to generate alpha, right? And I think that's where we really thought of bringing these two things together. So if you can bring in the alpha generation that a fund manager can do by choosing a particular investing strategy. So in this case, we have Ajay, a very experienced equity investing professional, and a unique approach to sort of building an index or a portfolio, right, of equity investments. And then we overlaid it with structuring of a structured product, right? So what we have basically done in this case is we basically brought in the underlying from a Nifty. We changed it to this Leap index. Now Leap is a custom index that we have created in-house. Technically, we have the ability to create or structure these products on any given index, and we have also done the same with some other managers as well. What we do then is we actually synthetically create options on this, and we package it inside a market linked debenture. What that enables us to do is we are able to offer an investor the opportunity to invest in this equity portfolio, right, through a structured product. But either you can go for a low risk version, as we were discussing in the last session. You can go for a capital protected structured product, right? If you choose to go for capital protection, we are able to structure participations on this index to the tune of around 100 to 110%. So at least you are getting the full upside of the equity index, or maybe a 10% extra multiplier. But on the downside, it comes with capital protection. So in case, let's say, over a 2-3 year period, depending on different products, over a 3-year product, 3-year tenor, let's say, this index were to actually fall, right? Irrespective, your capital will be protected. So that minimum capital will at least come back to you. But in case the index performs, then whatever performance the index generates, along with the alpha over its benchmark, you will get the due percentage or participation on that on the upside. We also did, constructed a higher risk. So there are a lot of equity investors who are also looking to basically, get better beta on the markets, or, to basically get better participations. And so we created a portfolio with the same risk, which is 1:1 downside on the market on this index. But on the upside, it enables you to get, between 1.4 to 1.6, 1.65x of the index participation on the upside, right? And I think that basically we are able to do, given our experience on the structuring and the derivative side. So obviously, it's a slightly more nuanced approach. So to make something like this work, the universe, while the inputs come in from the fundamental aspect, you also have to bring in the structuring aspect of this product to really look at stocks which are available in the F&O segment. What is the kind of liquidity that is available? What's the kind of open interest that you're seeing over a period of time? So a detailed amount of, and a large amount of due diligence on that is required to really then bring these two together to generate and create a portfolio like this. So just to give you a sense of what this looks like, as I said, this is just one of the examples wherein it enables you to participate in the upside of this index. So you get to participate on the positive side with a 1.65x multiple of the index returns. There is no cap on this, so it's an uncapped return. If tomorrow you have a runaway rally for the next 3 years, whatever this index generates, you get 1.65x of that, right? You get multiplied returns, which means faster growth via additional alpha. Instead of a 1x, you are getting that 65% extra. But on the downside, it comes with only 1x of the downside. So what that basically means is, let's say if you had bought any long only fund, you would participate in the upside of the fund one time and the downside one time. But in this case, there's an equity portfolio on which you are participating, or on the downside, you're still getting a 1x risk. But on the upside, you are going to earn, let's say, a 1.4, 1.6x of that funds returns on the upside. That's what it looks like. So if let's say this index were to return 20% over, let's say, a 3-year period, this product would give you 33%. So 20% multiplied by 1.65x, which basically is the kind of multiplier. But as you can see on the downside, if the index were to fall by 20%, you would still lose only 20% of the capital. It's a 3.5-year product with a market position or for 3 years. It's the underlying, as I said, in this case is the LEAP index, and it's a secured paper with 1x security cover with a charge created in favor of the independent trustee. And as I said, this is the principal not protected version. These do, given the higher risk, these come at a higher ticket size to investors as well. Also, these products, when you offer them without capital protection, you cannot offer, you cannot get them listed, because the guidelines in India mandate that only capital protected instruments, market linked debentures, can be rated by the agencies, and only rated instruments can then get listed. So I think that's basically the new product, which I think which is the latest offering from our desk, and something that we feel is the right direction for this market to take. And we hope that we are able to share it with the right sets of investors, and people are able to benefit from an offering that really combines the best of both worlds, right, for investors. Ajay, you want to add anything?
I think, Pratik, we have given all the details regarding the product.